Welcome to Stress-Free Investing Analysis. Personal notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
All right, with those formalities out of the way, I am incredibly pumped to unpack today's data with you. We've got a really fascinating company to look at today. It's one that's perfectly positioned right in the middle of a massive technological shift. But, it also comes with some serious financial realities that we absolutely have to unpack.
So here is our roadmap for this explainer. We're going to cover the Lumax growth story, the technology and their moat, do a reality check on their financials, see if their valuations are priced for perfection, and finally, wrap it up with our stress-free verdict. Let's jump right into Section 1, the Lumax growth story, India's pure-play auto lighting leader.
Okay, so Lumax Industries, currently trading around $5,644, is a true powerhouse in the auto ancillary space. Founded way back in 1981, they've practically cornered the market. They've got 12 manufacturing plants strategically placed near all the major auto hubs across India. But honestly, the real jewel in their crown is their highly lucrative joint venture with Japan's Stanley Electric. Stanley holds a 37.5% equity stake, giving Lumax access to absolutely world-class technology. Plus, they dominate with original equipment manufacturers. Maruti Suzuki and Honda alone make up about 45% of their revenue. That is fantastic for steady income, though, it does create a bit of a concentration risk if either of those automakers faces a sudden slowdown.
Now, this is the real game changer. We're talking about the structural, industry-wide shift from old-school halogen lights to modern LED lighting. LED now commands a massive 61% of their revenue. And why does this matter so much? Because the value of an LED unit is significantly higher. An LED headlamp can be literally 2 to 4 times the price of a halogen one. So this transition is driving up Lumax's revenue per vehicle without them even needing to sell more physical units. It's a structural upgrade, not just some cyclical trend.
Furthermore, they are totally future-proofing the whole shebang. A lot of auto ancillary companies are terrified of the electric vehicle transition, right? But not Lumax. A whopping 37% of their 1,759 Crore order book is dedicated purely to electric vehicles. They are supplying for upcoming platforms like Tata's BEV, the Mahindra BE6, and the e-Vitara. They are riding this EV wave, not fighting it.
Moving on to Section 2, the technology and moat, defending the market.
So how exactly do they keep competitors from stealing their lunch? Well, they defend a massive 35 to 40% market share in four-wheeler lighting with a pretty formidable moat. First up, massive switching costs. Automakers design a car model to last 5 to 7 years. Once Lumax is designed into a vehicle, switching suppliers mid-cycle is nearly impossible because of the intense regulatory approval process and heavy tooling costs. Second, that Stanley Electric JV gives them exclusive access to advanced tech, like matrix LED and adaptive driving beams, that domestic rivals just can't easily replicate. And finally, having 12 plants right next to the automakers allows for just-in-time manufacturing. That is a logistical nightmare for any new competitor trying to break in.
So, the top-line story is absolutely fantastic. They have the moat, the EV transition, the LED upgrade. It sounds perfect, right? But we need to pivot for a second and ask a very crucial question. If they are doing so incredibly well, what is happening to the actual cash?
Let's get into Section 3, financials, the reality check. High growth, heavy capex.
Let's strip away the hype and look at the raw numbers. While revenue has grown at a stellar 25% 3-year compound annual growth rate, leaping from 2,320 crores in FY23 to 3,400 crores in FY25, and profit after tax is up nicely too, their free cash flow has actually been negative for the last 2 years. Negative 124 crore in FY24 and negative 110 crore in FY25. Why? Because they are deep in a heavy capital expenditure cycle. They're building massive capacity expansions in Bangalore and Chakan just to meet all those future EV and LED orders.
And because their cash flow from operations isn't enough to cover this huge expansion, they have to fund it somehow. They are borrowing heavily. Their total debt has surged 163% over 4 years, going from 338 crores in FY21 to a staggering 888 crores in FY25. This means their debt-to-equity ratio has crossed 1.0 and is currently sitting at 1.15x. Now, to be fair, this is productive debt. They are building factories, not throwing parties. But an increased interest burden directly eats into their profit margins.
This leads us to arguably the single most critical data point in this explainer: return on incremental invested capital, or ROIC. When a company takes on hundreds of crores in debt to build new factories, we want to see a high return on that new money. But Lumax's recent ROIC is just 6.2%, which is well below their estimated 14% cost of capital. They are investing heavily right now, but the incremental return on that capital is lagging. Now, this should normalize as their new factories fill up with orders, but for now, it's a significant timing and execution risk.
Which brings us to Section 4, valuations. Are they priced for perfection? Let's analyze this 107% rally.
So, you might be wondering, how is the market pricing a company with a brilliant structural business model, but heavy current debt and negative free cash flows? Well, the market has been wildly optimistic. The stock has experienced an extraordinary 107% rally over the past 12 months alone, massively outperforming the broader Nifty index. Investors are clearly looking past the current debt mountain and betting heavily on that future EV and LED payoff.
But that 107% rally has a major consequence. It has pushed their price-to-earnings ratio to a lofty 32.5x. To put that into perspective, that is a steep 43% premium over their own 10-year historical average. The market is demanding absolute perfection. They're pricing in significant margin expansion and volume growth simultaneously, meaning if Lumax misses even a single step, there really isn't much of a safety net at this multiple. At this high valuation, we have to watch the red flags very, very closely. First, the stock's rapid rise triggered exchanges to put it in long-term ASM stage 1, meaning it's under surveillance and could face trading restrictions. Second, as we discussed, that 6.2% ROIC is below their cost of capital. Third, a massive 47% of their profit before tax in FY25 came from other income, which includes things like subsidiary dividends. You really want to see core operations driving profit, not just other income. And finally, they still rely heavily on importing LED modules from China and Japan, which limits their profit margins, especially with anti-dumping duties in place.
Section 5, the stress-free verdict. Let's balance out the risk and reward.
It's a classic tug-of-war. On the bull side, we have a nearly flawless operational case, driven by the EV transition, an accelerating shift to higher-margin LEDs, and management guiding for 20% plus revenue growth by FY27. But on the bear side, we have rising debt, zero free cash flow right now, and absolutely no margin of safety on a valuation that demands sheer perfection.
In our scenario analysis, you can see exactly how this plays out. Our bear case targets 3,800 rupees if margins miss and auto sales slow down. Our bull case targets 7,800 rupees if they execute perfectly. But look right there at our base case, 5,900 rupees. With the current market price sitting at 5,644 rupees, it is uncomfortably close to that base case. This means there is very limited upside for new investors jumping in right at this exact moment. The 107% rally already pulled forward a lot of those future returns.
Therefore, the final verdict is a hold if you own it, or selectively accumulate if the stock dips into the 4,800 to 5,000 rupees range. At that level, the risk-to-reward ratio becomes far more attractive. If you do hold, a smart stop-loss trigger to watch would be if their EBITDA margins, their core operating profitability, drop below 9% for 2 consecutive quarters, as that would signal a structural issue. Overall, Lumax earns a stress-free score of 62 out of 100, which is a solid grade C+. It's a fantastic company going through an expensive growth phase, currently trading at a premium price.
So, in a market demanding absolute perfection, will Lumax's EV bets pay off fast enough to outrun their mountain of debt? I'd love to know what you think. Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a CB-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a CB-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video. Thank you for watching and keep your investing stress-free investing.